Hey everyone, welcome back to the Dividend Talk podcast. My name is Derek and today I'm going to talk to you about Schneider Electric. Schneider Electric is a European powerhouse who has been around for over 180 years. But today I want to talk about them from a dividend investor's perspective. But before I get into that, if you like this show, if you like the podcast, please consider liking and subscribing to our channel. Honestly, it means the world to us and it really helped the channel out a lot. I'll see you on the inside. So as I was saying, Schneider Electric is really a European powerhouse. It is a global leader in energy management and automation solutions. The company has many products and services that help their customers manage their energy usage, reduce their costs and improve their efficiency. And they operate in four main segments. They operate in energy management, industrial automation, secure power and electrical distribution. And I mean, if you look at the industry trends that these guys are in, I'm really strong and bullish on industrial automation and electrical distribution. Pretty much because that's my background. I was studied as an electrical engineer before moving more into the industrial automation world. And I do use these products quite a bit, particularly for digitalization. So one of the key things we try to do where I work is we try and optimize our operations. We use products from Schneider Electric to help us improve productivity, improve the quality of the product we make, and improve safety and also reduce downtime and associated costs. And it's the same with electrification. Look, we're talking about transportation, cars, vans, trucks, all becoming more electric over the next few years. They're going to need an ecosystem. They're going to need drivers. They're going to need electrical components that are going to help drive these. And Schneider Electric are in a really good place to take advantage of this. So one of the first things that I like to do when I'm looking at a company is I like to run them through my screener on Kyfin.com. And if you look at the screen in front of you, you can see that the total revenues has been increasing quite slowly actually over the last 10 years, but it has been increasing and that's important. Also look at the net income. And the net income has nearly doubled since 2013, along with the free cash flow. So free cash flow was about 2.4 billion back in 2013. It now stands at around 3.6 billion. So we can see those figures there. We can see basic EPS from continuing operations that has been growing quite significantly, helped of course by the buybacks that you can see on the line above that. We can also see free cash flow per share and dividend per share increasing as well. One thing to note is that their long-term debt is more than covered. It's currently standing at around 7.5 billion. They've got cash on hand of about 4 billion and their EBIT to interest expense coverage ratio is around 33.7. So just looking at this from a screener perspective, it passes all my checklists. I mean, the revenue is growing, their net income is growing, their free cash flow is growing, their dividend is growing and their debt is manageable. And pretty much their coverage ratio is exceptional. From a screening perspective, Schneider Electric would pass all my criteria and they would definitely be worth a deep dive into. For European investors, I think it is really important to check the dividend policy for each of the European companies that you hold. A little bit different to American companies who always like to pay that dividend. European companies tend to have a little bit more of a conservative payout ratio, but also they do like to cut the dividend quite quickly whenever trouble arises. So I do like looking at that. What I do take a lot of solace from here is that the dividend payout ratio is in and around 50% of adjusted net income. So if we're going to see that net income rising each and every year, then these guys should increase the dividend with that. They have a nice chart here from 2009 up as far as 2021, and as you can see, they have actually increased it every year. This is a little bit out of date because they've just announced that their next dividend, which will be paid on the 11th of May, will be for €3.15, which is a 9% increase based on last year. So they have a solid dividend history, and as they said, it is quite progressive, and they intend to pay out 50% of adjusted net income, and that's important. Once that net income is increasing, then we should see the dividend increase with it. If I flip back over onto Kyphin there, I get a sense of their annualized growth rates. So I do like to have a mixture between high growth and low growth and high yield and low yield. But typically, I always like to make in and around 8 to 10% return on what I'm investing in. If you look at the growth rates here, over the last year, it's around 9%, and 10 years it's 5.3%, and they have a dividend yield of 2.11. So over a 5-year period, they'll just about scrape in and make my criteria. Over a 10-year, as you can see, it is underneath my required returns. But all in all, it's still a decent return from a European company like this, particularly one that is said that they're going to progressively pay their dividends. So as long as that net income is increasing, I'm confident that we can see 8 to 9% increases over the next few years. So is the dividend safe? Based on my metrics and what we use, I believe the dividend is very safe. I've scored it 83 out of 100. That is quite good. We based that on their average free cash flow rate of 5.98. I would like to see that a little bit higher, but their earnings per share growth rate is 9.16 on average over the last 5 years, and that's pretty much in tandem with their dividend. So once that's increasing, we should see that dividend increase just slightly under that rate as well. If you look at their debt levels, their debt to equity is quite good. It's only 29.58. Their interest coverage is 33.7. I look for about 7, so anything above that is pretty strong. So 33 is a good number, and they've got a decent credit rating from Moody's, which is an A2. The payout ratio, as they said, is in around 50%, and that's the number that I calculated as well in my manual calculations. They've got a strong commitment to dividends, so the last 14 years they've either grown it or kept it the same, and that 5-year growth rate is 7.44%. So overall, I would say the dividend here is very safe. So finally, let's have a look at our stock on a page dashboard that European DJI pretty much designed and we populate for all our European companies. As I mentioned before, this company has a pretty good dividend history, as we can see here, and the free cash flow payout ratio is quite steady. I would say it's always in and around 50%. Some years it's a little bit less, but it doesn't really go above 60%, which is quite good. If you're looking at some of the competitors of this company, of Schneider Electric, then they operate in lots of different segments, as I mentioned, but some of their main competitors would be Honeywell, Siemens, ABB, and Rockwell Automation would be another one. And honestly, those 4 companies I think are worth a deeper dive as well, as I think they're all pretty good companies. Looking at some of the opportunities for this company, I think there's a growing demand for sustainable energy and energy efficiency solutions, and I think they'll be a real pioneer within that. There's also an increasing demand for automation and digitalization. Obviously, there are some risks. So this company seems to depend on a few key suppliers for their components, and you can see that when we had this supply chain issue as well recently. A lot of their products we were not able to get because they depend on so few key suppliers. So that is a huge risk. And honestly, if you were to look into the likes of Rockwell, ABB, even Siemens to an extent, I think their innovation in certain areas is a lot stronger than Schneider's. But overall, I don't think these risks are anything too big to worry about, but I think you have to know that there are risks there. If we look here then on the top right hand side, we can see the key statistics. And generally speaking, I like to see these all green. But in all honesty, this is probably good enough for a company like Schneider Electric. The big hitters here are the dividend yield, which is a little bit lower than what I'd like for a European company. Usually I want that in and around 3%. And the price to earnings and 4 PE ratio is in and around 24, which is quite high for a company like this. I would much rather have this under 20. And lastly, I calculated my fair value based on a discounted cash flow model. So I used a baseline of about 3 billion as their free cash flow. I got this as the average over the last 10 years. I've also used growth rates from between 3%, which is bearish, up as far as 7%, which is optimistic. And I've given a discount rate of 10%. So My range here is between €65 and 112 if I'm being really optimistic. But at the current share price, which is in around €149, it is overvalued by my estimation. So that's my one real problem with this company. I really like to own more of this company, but I just think it's too richly valued to get involved in. But it's definitely on my radar, and I'm hoping that we might see some bit of dip in their share price so I can buy a little bit more of this company. So that's my quick run through of Schneider Electric. I hope you liked it. If you do, as I said, please consider subscribing to this channel. Also, if you have any feedback or if there's any companies you would like me to look at, then please let me know in the comments below. See you all again.